This is 1320 WILS. I am Michael Cohen. It is Friday, and after months of standing still, the market today making a huge move downwards. The Dow dropping almost 400 points. What's ahead? What's coming up on Monday or the rest of the week, next week? Let's talk to Clark Hodges, financial strategist at HodgesCapital.com. Clark, always great to touch base with you.
Hey, good to be on again. Thanks for having me. Enjoy it.
And thanks for joining us on WILS. What did you think today when the market closed 400 points down? At least the Dow was down that far.
Yeah, honestly, not much. I mean, you're reacting to the Fed speak. The indicators are out there that the interest rates are going up, and there could possibly be a rate hike this month. And I think the market is saying, if they do another rate hike, we're going to have a sell-off, and that's the reaction to an already built-in rate hike this month.
Do you think we'll see both of those things occurring?
A rate hike this month?
Yes, and a sell-off following?
It'd be total speculation and guessing on my part. I have absolutely no way to tell. And by trading activity today, you could argue that point that it's built in. But at the same time, what about trading activity on Wednesday or Tuesday of this week? It didn't react that way. So
but it had been like months essentially, right? Where the S&P was barely moving, the Dow wasn't going anywhere. Could this be the beginning though of a much bigger downturn? What we saw today, could we come into Monday and have something equally large happening?
I do not think so. I do not see a wall of worry out there. I do not see a bubble. I do not see a sense of euphoria that everyone and their grandmother is making money in the stock market. I see the opposite of that, actually. I see a bull market that's very unloved. Nobody thinks it should be going up. And I see the statistics tell me that the outflows of mutual funds over the last several years has been net negative. So people are taking money out of equities, and you just don't have crashes and bear markets start when money's going out of equities. You only have that kind of thing happen when everybody and their grandmother's buying equities and saying, hey, get in. This is the greatest party ever.
Where is the money going if it's leaving equities?
It's going to bonds. It's going to bond alternatives. It's going to the mattress. It's going all those kinds of places.
Okay. So at what point, though, because no one knows where we're really heading, at what point are you going to potentially change your mind? How much of a move do you need to see the market make before you go, well, maybe we've seen a top here?
It's so hard to say. I tell you what, there's areas of the market that would benefit from a rate hike. And so that's what we do all day long is we look for the risk reward out there of what if there is a rate hike?
And
what kind of industries, what kind of stocks would actually benefit? And I'm here to tell you that the smaller cap companies would probably do better if there was a rate hike, because a lot of the smart money, so to speak, has been going into utilities and conservative dividend-paying type stocks as a bond alternative. And I think if rates go up, you'll see money come out of that sector and those kinds of companies into more growthy, more quote-unquote risky not being a bad word, investments, as opposed to a safety of a 3% dividend yield while you wait on the market to do so.
Clark Hodges with HodgesCapital.com here on 1320 WILS. You never seem rattled at all, though. I've never heard you in any way really concerned about where things are going. Why is that?
Well, we don't even listen or think about the market. The Dow Jones Industrial Average is 30 stocks. What we do every day is we get down into the trenches and we talk to companies and we hear what companies are doing, good, bad. We talk to what their future looks like, and we look at the business and we analyze it as if we were Warren Buffett and going to buy the business. And we say to ourselves, would I buy this business knowing what I know about it today? And so when you have that perspective, you don't care what the market does the next day.
But what
don't even care what the market does the next month. You care where the company will be valued 2 years down the road.
Okay. You don't imagine we will have a downturn where stocks may not reach these levels for 2-3 years, something of that size?
Oh, no, I don't think that at all. I think we've gone through a 5-6 year bull market that I think will extend at least another 5 years, 4 or 5 years. It won't go straight up, and you'll have times where it pulls back, and but I don't see a bear market. The previous 10 years was a horrible time for equities, and bonds did terrific. And I think it's just actually kind of the equity market's turn to do well, and it's done well since about 2010, 2009. But I don't expect a prolonged 2 and 3 year pullback in any way, shape, or form.
Now, when you look at the larger U.S. economy and what's happening in Europe, does that go into your judgment of what's ahead and the companies you invest in? Or?
Oh, yeah, because if you're a business that's generating their revenues from the consumer, then you need to take into consideration how the consumer is. Is the consumer healthy?
So
is the consumer confident?
Are you saying you feel the U.S. economy itself is in a good place and will continue to be so? Or?
I think it's a fine place. It's not great. It's not something to go, wow, look at this growth engine. It's not like that at all. But there's pockets of the market that you just say, hey, I mean, that's a solid business. One of the things we always look at is what is the competition like in the industry we're looking at? Because if it's too easy to get into that industry, we don't want to own it. If it's a tough business to get into, then you recognize that once this industry starts to have good times, this company is going to participate in those good times because somebody can't just come along and jump into that business. And I'll give you one example of that is if you and I decided we want to start a railroad company today, how long would it take us to get the tracks laid? So there's a high barrier to entry to get into the rail business. But when the rail business turns up and is really good, all the railroad companies will benefit. And so you just want a piece of that pie, and your piece is going to get more valuable because there's no other competition out there.
Now, do you wait, once you identify a company, do you wait for a big hit to the market where things turn down before you go in? No.
You look at the company as an individual, and you say, I want to own this stock, and you start buying it no matter what the market's doing. And if you get a pullback, then you say to yourself, I know the company. I know this is a pullback based on the market and outside forces, and the company is on sale today. I'm going to buy more of it. You build a position in it over time. That's the way we do it, at least.
Do you ever go to their facilities and visit them?
Oh, yeah. Oh, yeah. We have analysts that go and actually, take plant tours, go on properties, see the actual way the widget is made, and meet management, figure out management's capability, figure out management's ownership of their own company. All that sort of stuff factors into the decision.
Clark Hodges, financial strategist at HodgesCapital.com. The market may have taken a hit today, but he says that's not something to judge the big picture on. Clark, thank you very much for joining us on WILS.
Oh, you're welcome. Thanks for having me.